So greetings and welcome to everyone to this Macro Hive webinar. My name's Bilal Hafiz and I'm the CEO and head of research at Macro Hive. Now, one of the things we found over the course of this year is that all of the educational content that we produce, which include our explainers on key concepts in financial markets, have been wildly popular with our audience. So we're planning on hosting seminars and webinars like the one today to help educate our members and people who follow Macro Hive on important and crucial aspects of markets. And today, we're very lucky to have Thorsten Wegener, who will be talking about the ins and outs of volatility, how you should understand volatility in markets, and then how you can use volatility in your investment decisions. And the reason we wanted to start with this topic when it comes to derivatives is that before you start to use options, whether it's calls, puts, or other types of derivatives, it's really, really important to understand volatility. And if you get that understanding right, then everything else falls into place. And just for your reference, for those of you who don't follow Macro Hive that closely, you can go to our website and sign up for our free newsletter. And there you can get insights on a weekly basis to what we do. And if you become a paid member, you'll get access to all of our content, whether it's market views or the explainers. Now, in terms of this webinar, we have Thorsten Wegener. And his background, he has a great background. He's been in markets for I'd like to say 20, but it's probably 30 years plus. He has the odd gray hair or two you may have noticed. Amongst his various roles, he was at Bear Stearns, where he ran one of the major equity derivatives groups. So he has the right credentials. He ran some of the biggest equity derivative desks on the street, and he really does understand derivative markets very, very well. And in more recent years, he's left working for big banks and instead has gone on a bit of a crusade to educate people in all things derivatives, and he has lots of excellent courses. He's based in Germany, and we've started a partnership with him where he's helping our audience understand derivatives as well. Now, in terms of the structure of this webinar, Thorsten will give a presentation that may last around 1 hour to go through all of the key concepts of volatility. You should take notes, but if not, there'll be a replay available where you can access both the presentation and the content. Then towards the end, we'll then open it up to Q&A. And to participate in the Q&A, just hit the Q&A button on the Zoom screen or the comments one and just ask questions. Then I'll host it and throw the questions at Thorsten. So without further ado, let me hand over to Thorsten, who can kick off the session.
Thank you very much. I will start sharing my screen. Wait a second. You can hear me, yeah?
Yeah, we can hear you well. Thanks.
So, share screen.
Great. Yeah, we can see the screen, which is great. So
and now you see the presentation full screen. Yeah?
You see the presentation. Everything's looking good. So the initial Zoom fear and worries are over. Hopefully, it'll go smoothly. So over to you, Thorsten.
Lovely. Thank you. Thank you very much for being our guest today. A great honor, great pleasure to work with Bilal and give these little, you call them explainers. And it's something which is very close to my heart. I taught my trainees in the good old days how to trade options, how to maneuver markets. And later on, after a long spell of being just a house husband, cook, chef, and Uber driver for my kids, I started again teaching and surrounded myself with a very nice team of young men and women who want to learn and who are literally operating as my own private hedge fund. So what am I going to do today? The headline, probably profitable, is a question I get all the time. How do you become profitable? Yeah? And I always say volatility is the most important thing in markets. Volatility shapes markets. It shapes all markets. So what I'm going to do today is, let me briefly run you through the agenda. First, I'm going to build up a narrative, the philosophy behind it all. Then we dive into reality, which I'm going to destroy, unfortunately. Then I'll explain to you how volatility can be used. And then we have a little giveaway at the end with something you can actually use and apply and simply cross-check whether that topic I'm touching today makes sense, and whether you can actually see what I will have told you in the real life, and I'll give you the tool to do that. So, evil risk disclaimer, obviously everything I do today is simply for educational and entertainment purposes, and by no means shall be construed as investment advice. The question I get a lot is, are successful speculators made or not? Are they born? And there's a fantastic quote by Calvin Coolidge, the 30th president of the United States. And let me just read that to you, and then I'm done with the reading. Obviously, everything is on the slides. Nothing in this world can take the place of persistence. Talent will not. Nothing is more common than unsuccessful men with talent. Genius will not. Unrewarded genius is almost a proverb. Education will not. The world is full of educated derelicts. Persistence and determination alone are omnipotent. The slogan "Press on" has solved and always will solve the problems of human race. And I think that is very fitting if you are working in the markets. Nothing is easy. Nothing comes easy to you. You have to build up all these skills, the education, but you have to stick with it. And you don't have to be a genius to maneuver the markets professionally and successfully. It's just a question to build up things you don't know yet. And that is hopefully what I can achieve today, and introduce you a concept or way of thinking about markets, which has helped me in my, and Bilal was right, it's not over 30 years, 27 years in the industry, and served me quite well. So, the actors, the decision-making process, and the consequences, the philosophy behind it all. It always helps to have a look at what markets in general really are. Before we go into too many details, let's focus on what is the kernel in it all. Where do we find the real, well, guiding flashlight, or how do you call it? The guiding, well, yes, the guiding light for us all. And it's taking a step back. Who is responsible for prices observed in the marketplace? Well, if we, and I love to break it down into the extremes, you'll see that in this presentation a couple of times. In free market capitalism, it's all market participants willing to bear the consequences of their actions directed by the invisible hand. Adam Smith, obviously. And what's on the other side of the extreme? Socialism. All stakeholders through an alleged democratic process implemented by bureaucrats, and the director of this game is, I call it, the incapable hand. Important to say here is that incentives always work. In free market capitalism they work, and in socialism they work. They're just different incentives. So if we can explore the incentives behind each system, then we probably can make good forecasts about what's going to happen next. We are obviously somewhere in the middle. Different countries are closer to free market capitalism than others, which are closer to socialism. And especially at current times, you hear a lot of conversations whether we've reached the end of capitalism again, especially here in Germany. And well, I've heard it all before. We just have to be aware that there are political streams which could influence our decision-making process, which is, how do we arrive at investment decisions? And there are 4 points. Trust in God, trust in luck, do good analysis, and probably all of the above a little bit. Especially newcomers to the markets, they think they have an idea, then they execute their trade, and then the trust in God and the trust in luck is also in there, and they're fevering about their positions. A trade necessary, I think, for our industry, but you have to keep it really on a small burning flame. So, how do I approach my process? And first of all, I always look at the macroeconomic situation we are in. I would like to have tailwind, not headwind, when I do my investment decisions. So that's the all overriding factor. Then I look at the fundamentals. Once I've identified a sector or sectors where I want to be either long or short, then I look at the most promising companies in this sector and draw my conclusions. Which one in this tailwind scenario I would like to be long or short. Then I obviously crunch the numbers in my Excel sheets and look what did the past say about these companies, markets, individual sectors we have in there, because there's a lot of repetition we can see. And especially when we go into the statistical concept, which will hit you in this presentation, and most of you will obviously have always thought about it. Yeah, history repeats itself. It was Mark Twain who said that. It doesn't repeat itself, but it rhymes. And finally, one of the sectors I grew up in, equity derivatives, but the whole derivatives market gives you fantastic sentiment where we are in the current station. And there are a couple of articles I've written on Macro Hive about gamma flips, which is in everybody's mouth at the moment again. It's a fashion. It comes back, it goes, it comes back again. But the option market is one of the most important timing indicators we are using. And getting these four sectors or profiles together gives me a very good framework to make investment decisions. And obviously the next trade, you're only as good as your next trade. You're never as good as what you've done once in the past. Talking about the past, there's a slide, source unknown, not verified, but it sounded plausible to me. One of my colleagues sent me over about the best investment legends ever out there, performance over years. And there are a couple of people who influenced me in the way of thinking. John Templeton, I remember I was a young trader around the 2000s, and he built up huge short positions in the TMT bubble then. And he was very successful, while others like Druckenmiller first got burned on the way up, and then actually didn't do anything anymore, just standing on the sidelines. But Templeton, he was, I think, well in his 70s or 80s by this time, was once interviewed and asked, how did you build up the shorts? And he said, well, I had a general understanding of how human beings work. There are so many young millionaires, at this time only millionaires, not billionaires yet. Another point about inflation, by the way. So many young millionaires in the market, they want to stay millionaires. So we had a look in the holding periods, the blackout periods, until they could start selling their own stocks. The market was at an all-time high at this time. Everybody was extremely bullish on everything internet related. And Templeton simply got his team on the case. They checked it and they started building up short positions. And well, history can tell the rest. A lot of these companies don't exist even anymore. Then obviously Warren Buffett, a fantastic strategy, taking companies off the market with a very strong cash flow, keeping them in his portfolio, and when the market comes around again for the next bull run, well, then he refloats them and makes fantastic earnings. Jim Rogers, investment biker, driving around the world, going into the fundamentals, having a very good idea what companies are really strong and have growth organized. And then my personal favorite, Jim Simmons, Renaissance, right here at the top. Obviously, the man who also invented the Black Scholes formula at the same time as Mr. Black and Mr. Scholes did, but he didn't tell anybody. And he has this fantastic performance now for over 30 years. And he's working with a lot of the quantitative analysis of statistics in the trades, observing the market from a mathematical view, trying to black out your personal ambitions you might have in the market. He's not falling in love with stocks or hating certain positions. He's just following what the sentiment of the market and the quantitative analysis are telling him. And I'm pretty sure they also look into the different sectors. They're having the big macro picture. So how the average of the market participants always reacts is the most important point for us. Why? Because the average is the majority of the people, and majority make trends. That is what is in our mind all the time, to say, fine, being contrarian is fantastic, but you have to actually find the peak and the low. Most of the time, I want to know what the majority is doing. So if everybody eats pizza, selling pizza is not a bad thing if you have a good pizza in there. So what are they doing? Mostly rational, looking for returns or aiming to fulfill other predefined goals. It's politicians, they have their own goals, and they're all considering external, internal factors, restrictions, what the law tells you, what the tax situation tells you, how the markets in the various markets, world markets are trading at the moment, political risks, Corona, the black swans being made famous. These are all the things that are usually considered rationally, and then eventually not. It gets weird, and at the moment we are, I think, on the edge of one of these phases, like we've been on the edge towards the end of last year when everybody was driven by greed. Now fear is coming in. I just had a look, the 10 versus 2 is inverting even more. I think there is a good chance with the political situation and especially the energy situation we have at the moment that we could drift into, well, a global brutal recession emanating out of Germany into Europe and then into the whole world. But we follow the data, obviously. We want to see what's going on. And but then people get extremely, well, let's call it cagey. Yeah? The sound part of the brain suddenly stops working and they're reacting, I have to quote that again, like toddlers on a sugar high to inevitably crash, hard hitting from the monsters underneath the bed. So the consequences of this all, how do these reactions shape markets? Periods of trendless markets, new voting blocks are being established. And I use these voting blocks quite a lot to explain because voting blocks, it's very nice. If somebody, a marketer calls you and says, Mr. Wegener, do you prefer pizza or hamburgers? And at the moment I feel like pizza. I say, yeah, pizza. And fine, he takes a note and builds up a nice statistic and sells that to his customers. How reliable is that? Well, at the moment, I just fancy pizza. Tomorrow, I might go back to burgers and I might have that for the rest of the year. So these trends develop, slow at first, followed by accelerated market decisions, and these voting blocks, which are making these trends or perpetuating these trends, is obviously extremely reliable when your own money is on the line. And we have voting blocks in the markets all the time. If a marketer calls you, yes, you might change your mind or you might not be serious about. I can see actually the real voters in the markets because they have put their money in these markets and made a commitment, made a decision how to actually invest. And they are willing to bear their consequences. If not, they leave the market, go into other sectors or don't do anything. But all these observations give me real reliable data. And this reliable data, I obviously use to make investment decisions following especially on the peak points when trends break, followed by confusion, culminating in reassessment of the situation at hand, and new voting blocks are being established. It's one of the examples I like to show. Apple. Everybody's darling in every portfolio. It's seeing at the low risk trade. Risk off is almost okay. I buy Apple if I'm in a risk off market. However, I remember after the financial crisis, Apple was trading at a PE of 9, like a steel mill, about to get out of business. They already had these fantastic new products coming into the market. By this time, almost everybody I knew was already using iPhones, and the Mac came back. But these trends have changed. At this time, nobody was interested in buying high tech, by investing money into Apple. Now everybody sees it differently. So we have these waves coming in, and then the cycle obviously starts all over again. And if you're a while in the market, you have all seen that. What has been fashionable in the past becomes completely unfashionable to eventually being exchanged against something else down the line that it rhymes again, to quote Mark Twain. The big story is growth, and obviously the imagination is where's growth this time coming from, and then this whole process starts again. So what are we doing actually when we have an investment process? It sounds pretty straightforward. We're stacking probabilities. We start with a good starting point, always dumb luck. I could toss a coin and say, okay, if I buy a certain asset, it can go up or it can go down. Excellent. 50-50 chance if I don't know anything. Then I apply my little box of horrors. I go into the macro background. I go into the fundamentals. I look at the sentiment of the market participants, which was achieved through voting in terms of they were buying options, selling options. I can see the volume happening there, and obviously the quantitative approach to see what can the past tell me. And as the sum is always bigger as its parts here, we have a high probability investments. 75%, I started at dumb luck. And now if I have a good established process and know what I'm doing and I'm relying on what I'm doing, then I could say, yes, I have a pretty good chance that what I want to invest in will be successful speculation. All right. So life is very easy. All is good. Assuming that you listen to the right people, read the right research, have done your homework, are very diligent, and know how markets in general work, then you could say, okay, I analyze, I write the trend, may it be up, down, or sideways, and then I profit. All right. My answer to that is, let's play a game. Yeah? I've built up a scenario now where I can tell you, fine, as long as you follow certain rules and you surround yourself with clever people who are doing all these different steps and have an established process, things will be fine and you'll make the right decision. Now let's play a game and let's have a look whether we find some randomness in this whole thing. I always start with a lovely game with my students. I have here 2 assets going back till 27. So we have a good set of data here. There are 2 mystery assets. We have the blue line and we have the gray line. When I have more time, obviously, I'll make a little survey and let all interested parts give their comments, what they think, so I can sum that up for you. What I usually get is, yes, they're both generally in an upwards trend. The trend on the blue chart, asset Y, seems to be more prominent. Therefore, the gray chart seems to have more volatility. So it's more erratic in its whole behavior in there. Okay, so you listen to it, you analyze what you see in front of you, and let me solve the puzzle. The blue one you obviously have recognized. It's one of the most printed charts in the world. And on the right is a coin toss. The gray market was nothing else. Thorsten sitting on his Excel sheet, flipping coins and simulating prices. Interesting thing with this all is that is a surprising factor. You can calculate the volatility of a market, especially if you have the history of it all. And the drift. Drift is simply when you expect growth in a capitalist society. We have this steady trend, S&P for a long time, 7% annualized returns. So I used for my simulation experiment, the coin toss, exactly the same drift and the same volatility the S&P had. But I'm coming out at something which is perceived as being dramatically different. What is this chart? This chart is actually the daily returns over all these years from 27 onwards. And you can see the gray bit, which looks very in a straight line, around plus minus 4%, the daily returns. This is the coin toss. This is the simulated reality I had there, the real randomness. And the blue lines here, that's the S&P. You can actually guess here 1987, 2008, the Corona disaster we had, and the brutal rallies against it when we had days with plus 1,000. So what we can see here, that's why I wanted to draw your attention to is the market behaves random in a way, but not perfectly. There are things which should not happen if you just use the statistics, and options give us the opportunity actually to cut these tails off. You lose a little bit return when you employ options, but you're not getting completely screwed here or here or here or here. Well, over there you did because there was an existing option market, but nowadays we can actually use options to facilitate for this risk. And this is one of the points which tells you, yes, we're talking about randomness in these markets, but maybe not just quite yet. They're very similar to each other, and that has implications of how we're setting up our trades. And let's now have a look into the S&P, as this is now the focus of our research now. How did that actually develop? What kind of randomness can we see there? So what I did, I looked at the daily returns and took any random period, just like throwing darts, and said, okay, this is the time for, this is the week in 1993, first week in April. You could take whatever you please. And then I did the same for a quarter and said, okay, I take the daily returns of any random chosen quarter. And then I add a little bit more. I said, now I take a random year and look at the distribution of the returns. You already see what's building up here. And then I went for 10 years. And what are we having here now? I love to quote movies, by the way, and you will find quite a few quotes in here. And suddenly we're not in Kansas anymore. We have the fingerprints of randomness in our game. And when we see something like this, the bell-shaped distribution of returns, there's something we can actually use in our investment process. The hypothesis, obviously, is people do what people do. Yesterday, today, tomorrow, because they are the ones who are responsible for what we've just seen on the screen here. So let's make some historical comparisons, qualitative and quantitative analysis. And I have only 3 points here. Since men and women started trading with each other, might it be fish, grain, derivatives, oil, you name it, on average, the same pattern seems to emerge. Here's again this word on average. And that's what's interesting for us because we can derive decisions out of it. Then certain observations in our world allow conclusions to be drawn that the great architect wanted to be neutral and ended up with the Freemasons. So great architect created weird and wonderful constants to describe nature. And then my mantra, pattern recognition, I'm not inventing stereotypes, I'm just observing them. And if I can observe them in markets, I want to use this. Some examples of these stereotypes in air quotes, or the magic of the great architect, is obviously the speed of light. Nobody actually knows why it is this number it is. And what Einstein made out of his famous formula equals square energy equals mass square speed of light. Then we have pi. Pi in, and I do a lot of calculations for a living. It pops up in the weirdest places when you talk about probabilities. Why it has this value it has, I don't know. Why it shows up in certain things. There are explanations for some of the places it shows up, but nobody, I have the impression, really knows why we have it there. Then Euler's number, obviously growth processes. If you're interested in banking and interest rates, you use it all the time. Yeah, we use it for the log returns. It's simply the inverse. And then my students always start with and are most interested in an almost esoterical concept. Yeah, we all put at one point some Fibonacci lines on our charts just to have an idea what everybody else is looking at. And phi, the relationship, is also there, 1.618. So what does that mean for me? It means something is developing on the screen which has this hallmark of the great architect on it. Can it be explained? And I was a bit, well, straightforward, the mathematical proof, that's why I put it in brackets as well, or I'm in or Thanos, idea, where do we start here? We start with 100. That's a starting point. Say it's any asset, and over a long period of time, you think, oh yeah, this asset obviously has an uptrend, downtrend, like an Apple or an Amazon. But if we break it down in shorter and shorter and shorter periods, when would you consider saying, well, can I really talk of a trend if I go down to a day, to an hour, to 5 minutes, to the next second? And what can happen? That is the distance it can travel. For our purposes, I've chosen one finite point up and one finite point down. And then the next split second starts, and it can go back either to 89, to 100 if it's here, or it can go to 102 when it was at 101. So assuming that the very, very small time frame is actually a coin toss again, yeah? Who knows what happens in the next split second, then I can say, okay, let's count. Where can the outcome be? If I say, okay, where will I be at this point in time? 5 steps into the future, the 6 altogether. Then there's only one way to arrive at 95. There are 5 ways to arrive at 97. There are 10 ways to arrive at 99. And obviously, I didn't go through all of it. It's just a mirror image now of it all. And what we have here, there are 32 finite possibilities because we broke it down to the tiniest observable point. That's everything that can happen, 100%. And if you just look at, let's say at the 10, we have a 30 at 99, we have a 31.25 probability to end up here. And the same here is true for the 101. That's, by the way, how you price options. We just look at the individual probabilities, multiply that with the money you can make, and when we build the average, we have the option price out of it. So we have the bell shape here again, what I'm banging on about. We have all the individual observations, like I just showed you. Then we have a mean on average, where the majority of events happen. Then we have a standard deviation, statistical concept. I will elaborate that in detail a little bit more, but it's pretty much where the majority of the events will happen. We can describe that, and it has a certain symmetry to it. And we are looking for this symmetry we like to see. So how can probability improve our profitability? When we have these randomly distributed events that take the shape of a bell curve. And I researched when I did this little speech originally a while ago now, just to give some examples where we can find this shape. And you see it here, from average milk production of cows to the height of humans, an experiment I love to do when I have a larger group of students, to get them lined up by very small guys to very tall guys. And they will then see the bell curve developing, the attractiveness of populations. We have that as well. And obviously what interests us most is simply the return distribution of financial assets. And they have a bell shape there. So what's happening here now? We started with dumb luck. Then we did all that research, macro, fundamental, sentiment, and quant. And we thought we have high probability investments. So if I only use the cash equivalent, which means I can be long an asset, I can be short an asset, or I can be not in the market at all, am I back to 50-50? Was this whole process in the first part just an illusion? It's a trap, right? We trick people into believing all what the research, the analysts, what they tell you has actually manifestation. And then if you look at the data, especially over longer terms, as I just did for the S&P, we might as well toss a coin. So, but we can analyze that again and we can use it. We have the bell curves, and I called it, let's use the sucker. And these perfect curves in a truly imperfect world is the Gaussian normal distribution. Gauss, German mathematician, describes the distribution of random variables. And for our purposes now, I just showed you, it has the fingerprints of randomness on there. And if you look at the chart with the coin and the S&P, it's not quite there yet, but there's a big similarity in there. And if a certain event occurs randomly, certain patterns in the distribution, the general shape can be recognized. It might be fatter, it might be smaller, it might be higher, might be lower, but we can see that there's a bell curve. And if we agree to assume a normal distribution, it is likely that the individual events are randomly distributed. Conclusions can be drawn and actions initiated from it. So when I've done this part, then I usually end up with my first struggle session. All my students look at me and say, with all due respect, Mr. Wegener, you're talking bullshit. We observe trends everywhere. Okay, so okay, show me these trends. And they obviously always spit out the same stuff, which is in everybody's mind at the moment. And we have beautiful charts on the screen. So my team went through the work and we analyzed it for all S&P stocks. We are following over 500 now. And I say, not so fast. We have Apple here, fantastic trend, right? Nobody would doubt that. We go sideways for, well, almost 20 years. Nobody really interested in Apple, and then it takes off. That's the return distribution of the daily returns, simply put into a graph. What are you seeing here? The bell curve. Okay, next point I get then in the struggle sessions always, but it could be that we have far more days when the market is up, then the market is down. So we can count that. We have 2 up days in a way, we make a point there. We have 2 down days in a sequence, we make a point there. And then we look into longer data. These are the up and down days. Who has seen this shape before? It's a bell curve again. So we have our hallmarks of randomness. Okay, I've only given you one example. Let's quickly go through Amazon. Here's the return distribution of Amazon. Here's the up and down days counted. Tesla, a stock which tends to go sideways until it doesn't, breaks the hearts of a lot of short hedge fund managers, and then it goes sideways for a long time again under agonizing volatility. Return distribution for Tesla, up and down days in a sequence. NASDAQ, the Qs, return distribution, bell shape, up and down days. We still have the bell shape, even though we see, and that is something where I would start trading if I have a long portfolio, which I trade for longer days, a statistical anomaly in there. And that's why we do the quantitative research. Something can be drawn out of that. Then the euro dollar, bell curve, up and down days. You see it's less prominent with the really big volume trades here. 5 days in a row, 7 days in a row, 8, only 1 in all the data I observed, and up days, there was only 1 up day, or 1 up sequence of 9 days over the time, but it can be used. And the Dixie, obviously, you see the charts are a little bit older. A lot of things are happening there at the moment. The return distribution, beautiful bell-shaped, and the up and down days, the same. So this obviously is the volatility we have in there, which is shaping these markets. Markets go up, go down, they have returns, positive returns and negative returns. And what we've just seen here is that we can actually see that in the data we have. There's no denying it. The voting blocks have given us these shapes, and we had the pattern recognition. We can say, yeah, we observe it. I'm not making this up. It's really on the screen. You can use Excel sheet, download the data on Yahoo, do it for yourself. You see exactly the same data I've seen here. So in an example, I want to show you now how we can actually set up trades or analyze markets by knowing about this relationship. And I've taken obviously the big daddy, the VIX. Everybody's talking about the VIX. The VIX index is the volatility of the S&P 500 as it is measured, and everybody every day is just having, oh, what's the volatility in the market doing? That's what they're talking about, the VIX. So, and when everybody talks volatility, most people don't have an idea that we actually have 3 biggies there. The historical volatility, the realized, and the implied volatility. Which kind of volatility are we talking about? Historic is simply what happened in the past. We see how much this thing moved in the past, not just the S&P, any asset we are trading, and we can calculate that on an Excel sheet, very easy formula. Then we have the implicit, which volatility level is quoted in the market, and how is it quoted actually? In the VIX, obviously you see it on the screen. But otherwise, people buy options. They buy calls, they sell calls, they buy puts, they do all these transactions, and they pay a price for it. You can calculate out of it, and that is actually the estimate, educated guess market participants have. How much do they want to pay for risk at this point in time? And then the future realized volatility. This is, if we know what will have happened in the future before we do it, we can get, at least by theory, infinitely rich, and profits are guaranteed. Mr. Black and Mr. Scholes got a Nobel Prize for that with an equivalent portfolio. But this is actually, if we know this, we don't need to know the direction. We just need to know by how much a market will move up and down. So let's have a look. Future realized volatility, the unknown variable we desire to predict. This is here. If we can, at the point where the green triangle is, know how this will have happened, we can make as much money as we like. Then we have the historical realized volatility. A good start to model our forecast for the future or model the future. That's pretty much what we're doing. We're all employing our own models, our own ideas about how to approach this topic. And then we are here, and we've seen the history. We want to forecast the future volatility. How do we do that? Well, we pay something for an option, or when we sell it and we get a price for it. And out of this price, we can calculate the implied volatility. I'll show you in a slide in a second how that works. It's very, very easy. So what really is the VIX index? And that's why I'm going to explain this concept now. The VIX index expresses the market expected future volatility of the S&P 500. So when you see a VIX index today, that's what market participants guess what is going to happen in the future with the S&P. The VIX index is calculated using the implied volatility of at-the-money options, mainly with an average remaining term of 1 month. At-the-money options are simply options. If a market is trading at 100, then our options, which have an exercise price, a strike price of 100, are at the money, because that's where they are. Mainly that's how the VIX originally generated or originated. And that's why we can't have nice things. That's why I put the asterisks in there. If something becomes very, very popular, then usually the quant boys and girls are coming in using huge formulas and say we make it nicer. That's what they've done with the VIX. They're now taking in options which are not at the money, but further out, and also give them a weight to see how the market is pricing the whole volatility over the whole curve, a concept we can explain in a later seminar. And then the observed market price for at-the-money options gets seeded into the Black-Scholes pricing model, and the implied volatility, the volatility traded on the market, is derived from this. And this implied volatility calculated in this way represents simply what the VIX index level on the screen tells you. It looks like this. We know the strike of an option. We know the maturity. We know the spot price. We know the rates in the market, and we have the option market price, what people just paid in this moment for options with a maturity of 1 month on the S&P at the money. So then we can simply take the Black-Scholes formula and arrive at the implied volatility. And whatever is thrown out there, let's say 20%, that's the level of the VIX people are using. So what can probably be expected? I've drawn here the S&P again. What did I actually take? I took the S&P, and in blue you can see the VIX. You can already see the relationship. If the market is a fast market, which usually happens on the way down, the expected future level is quite high by market participants, the blue line. That's the VIX in here. This is very interesting. What we did, we looked at VIX levels when they were quoted, when people were making markets. And then we simply said, what is happening or what has happened over the next 30 days? The market is guessing today 20 as a volatility level. And then we looked for the next 30 days and said, what did actually really happen? Did the realized volatility, that what then will have happened, actually came in at the forecast, and we arrived at a 72.42% correlation of it all. So it's a very strong predictor most of the time, and you can see that here where the center of mass is obviously the VIX index, how option traders are in the market pricing options, paying this price for the big voting block there, has a pretty good idea as a swarm what will happen over the next 30 days. At least there's a correlation of 72.42%, and I've done trades with less correlation in my past. So the expected volatility can easily be used then to forecast markets. What do I have in here? 256 days. What I always say, if you can divide by 16, you can forecast markets reasonably well. What do I mean with that? 256 days is simply a trading year in trading days. And 256, that's where you recognize, as Bilal drew your attention to, that I'm a bit older. The square root is simply 16. And that simply means that plus minus 20% above or below S&P level of today. If the S&P is trading at 4,000, you have the VIX quoted at 20%, then in a year's time, this level tells you that the market will be the center of mass, the big points, the daily returns in a year's time will probably be between 4,800 and 3,200. You can easily do that by saying, where's the VIX level? Okay, VIX level is at 20. That tells me how it's going to be in a year's time. Obviously, you can also do the same, say, how is it going to be tomorrow? That's why we use the 256, the trading days. We look at level today, and then we divide the 20% VIX level we've seen today simply by 16, the square root of 256. And I get the trading range for 1 day within one standard deviation. So if you have a level today of 20 in the VIX quoted, you can say, yeah, in a year's time, the market says it's plus minus 20%, or not higher than plus 20, not lower than minus 20 most of the time. And you can do the same for a 1 day period. So you can say tomorrow the market will probably not trade higher than 1.25% and probably not lower than 1.25%. And then obviously you can also do the same for any period you wish. In this case, I've taken for easy math again, 25. Multiply the daily return I have already calculated by the square root of 25. And I can say in a month's time, the market expects it will not be trading above 4,250 or below 3,750. If you want to look it up, it's called the square root of time rule. Just memorize, you can divide it by 16. And then you have the daily returns expected for the next day, what the VIX is quoting. And it's pretty reliable. I'll tell you the numbers, how much, in a second. So, and out of these 3 data points I've just calculated, a year, 3 months, and 1 day, I can do this for every day, and I can create a so-called volatility cone. When we're here at this point, I look how's the volatility in the VIX as a trade forecaster, 72%, and then I calculate the days into the future with these barriers. And what you can see here, it gives me certain levels. And the other thing you can see here, a little preview. Where do we always tend to stop or make a little breather? We end up at this magic, strange volatility cone. So what is it? The magic 68, 95, 99% rule. The standard deviation, I've used the word, but standard deviation obviously has a meaning. It simply says, one standard deviation, what we were just talking about with the VIX at the moment, the calculation dividing by 16, 68% of all occurrences will happen within this gray corridor, 68%. 95% will happen within this corridor. That's 2 standard deviations. You simply take the 1 standard deviation multiplied by 2, or 3 standard deviations, already 99%. 99% of all things that could possibly happen in the future will be in this corridor, and only 1% will be outside. So 0.5% to the upside and 0.5% to the downside. And then we have the toxic events. Obviously, this is theory here now, which is nice, observable. I said that right at the beginning when you saw the spikes, we had seen the coin toss against the S&P. We see far more toxic events than theory would allow us to expect. So what are we doing? We're using options to cut that off, which will be the topic of a different seminar. But for our purposes, simply now, we can now make reasonable predictions by simply looking at the VIX, what the S&P will do in 68% of the cases, in 95% of the cases, or 99% of the cases, by dividing it by 16. And coincidentally, these are the at-the-money calls and at-the-money puts. If you add up the prices, you arrive at this corridor as well. Just again, for all the critics, yes, I know, we assumed returns, that they're randomly. We assumed that returns are independent, that there are no memories in there. We all know that's not true. Now we're looking at longer dates here, and then the return, the memory seems to disappear, and return fluctuates around an average value. Also a point of criticism, but for these purposes, as long as it works, I use it. And if I can cut off the things that don't make sense, here, this bit, and this bit, then I use options, and I'm playing in the region where it works most of the time. So then we have the volatility cone, and I call that say hello to Mr. Bayes. Again, a concept out of statistics. We update our estimates for the future all the time. I look at volatility, and then I make a guess, and then I take another guess when time has moved on. And what you can see here, I've done that at actual volatility levels every time I held this little speech, or part of this little speech. And what you can see here, they're blocking up, they're building up, there are several. So it seems to be some level of resistance. And you can also see we always seem to, even when we have a bull market, we tend to run at the 1 standard deviation levels. Here, it's the most obvious. Or when the market breaks down here, where does it stop? At this 1 level. And this is, again, one of these things we can observe, but we can't quite explain them, besides the fact that men and women always do the same. They've always done. And now it's the, obviously, I've told you now a lot with beautiful charts. Is that actually real? You can see, and I did show you something we have employed in transactions on the trading view screen with a little tool you will receive in a second. And that was 20 December 21. We plugged volatility levels in, and we drew the 1 standard deviation, 2 standard deviation, 3 standard deviation cones. And you can see, obviously, the market took a dive. Where did it stop and recovered? Where did it stop again and recovered? Where did it stop again? These are the levels where you want to be aware, you want to be interested in, to see it either if we stop there, which is usually a good indication to put on a trade. If you have a downtrend, and you want to play the suckers rally against it, if we crash through that, which can happen as well, that gives me also very valuable information, because the next stop might be 2 standard deviations. Then another day, 24th of February 22. Again, we've quoted the volatility here. That was the guess. This was blank when we did this. Where did we stop? Where did we have, obviously, other indicators in as well? Where did we want to go short in these transactions? Right here. What happens here in the meantime? No, we're in the center of mass. Nothing happens. Wasn't of interest for us. And then the last example here, an implied volatility cone. That was when I created this update to the presentation only a couple of days in. You can see here, where did the stop happen again? It happened right here at 1 standard deviation. If you're bearish and you had a suckers rally in here, that's the point. We didn't immediately were rejected to the downside, but what you can see here, it's a point of interest. And with all the other analysis you put in there, it gives you additional confirmation that people are obviously doing stuff there. You also see that completely different topic in options volume, open interest we have in there. So 1 point back, just a practitioner's tip. When you guess the volatility, take days with huge volume and look at the VIX, what it did there. Why? Because the most voting blocks came in and actually put their own money on the table to buy options with it. So you have a survey of high rollers who are risking their own money that might be more reliable than on a very low turnover day. So what did we have? We started with dumb luck. We went into macro, fundamental, sentiment, quant. We had high probability investment in the first part of the narrative. Then obviously I was trying to take that away from you if you're not trading options and said, okay, it could be dumb luck. We've seen the fingerprints of randomness all over that, what we've done here. But if I employ options, obviously I can say, how nice. I can use certain structures and play these corridors of probabilities. And as you've seen, within standard deviation, one standard deviation to the left and to the right, we usually have around 68 or 70% where most of the parties will happen. If you just trade equities or just delta one, just the product itself, you can be long, you can be short, or you can be out of the market. Options actually give you an opportunity to take advantage of this real-life observation we've seen works in all markets. If you get your risk management right, and I think after almost 30 years, I'm allowed to say that it works. I'm not broke, still working in these markets, worked in these markets very successful, so did my customers, and they all know about this concept because it should be always in the back of your mind to actually use it. I've spoken now for, holy moly, 50 minutes, and I could have done that in actually 30 seconds. One tweet to rule them all. How to explain normal distribution to a bro in the gym. And there you can see exactly what I told you. Many, many people in the gym. The majority is in the middle, and that's where you can see the fat center mass, 68%. And then you have the outliers, the really strong guys and the really weak guys. One more thing. What I promised you, Falk the Python Kühnert, it's obviously, he's one of my team members and works as a contortionist. No, the Python obviously is from programming language. He created this little tool for everybody who has TradingView at home. Click on the hyperlink in the presentation, then message Hive to the author. Click on the window that shows up and just put Hive in so he knows you're from us. Add to favorites. Falk will authorize you. They might do that, well, straight away or within a day when he's in front of the computer to actually hand that out to you, that you have access to this little tool. Guess your implied volatility, and you can start with the VIX. Very good starting point, 72% correlation, until you start using your own models and your own little refinements. And the days where there's a high volume, there are a million other things you could try, but start with the VIX, a good starting point. And then cone away and actually use it. And it not only works for the VIX, it also works for every underlying you could possibly imagine. You just have to get the at-the-money volatility for 30 days, plug it in your cone, and it gives you beautifully 1, 2, 3 standard deviations. And you can have a look whether the things I told you today actually make sense or not. So I would go to the Q&As in a second, but one point before we arrive there, these are a couple of book recommendations I have in here. Things we covered today is obviously the famous book, Random Walk on Wall Street, The Misbehavior of Markets. And if you're interested in options already, the book I was trained on as a young market maker, Option Volatility and Pricing, and the other books are very well covering as well. And before we go into the Q&As, I just say thank you very much for being our guest today. And if there's interest to see more of that, it could be next time option strategies. And I got one more movie quote in there. May the odds be ever in your favor. Katniss Everdeen from the Hunger Games. And I would kindly ask Bilal to take back, and we go to the Q&A, and I will light up a cigarette.
Thank you very much. That was excellent, very informative, Thorsten, as well. You can stop sharing the screen as well. Just one, a couple of questions have come through. First of all, I should just add to everybody to the PowerPoint presentation. So there'll be a replay of this webinar, and there'll be a link to the PowerPoint. So if you and also a link to the tool that Thorsten mentioned, which allows you to put any instrument in. Include
Bilal, we can just PDF it, and the PDF has the hyperlink automatically in there. Just go to
so we can, so within the PDF, absolutely.
And then you're in Trading View if you use it.
So if you got an email for a follow-up email, which will have all the material associated with this.
Excellent.
A couple of questions coming through, Thorsten. One was around the volatility cones themselves. As a trader, would you, a currency or Tesla or whatever, look at the volatility cones based on implied volatility, and then would you then take a view on the market and say, look, my view is that means that I've got an option strategy to do. I mean, so how do you operationalize the volatility cone?
Well, your line is breaking down a little bit, but I think I got the gist of your question. So how I utilize it, I do my analysis. Obviously, I start at macro Hive. I go into the macro picture. I have an idea about the market. In which sector do I want to be? In which sector do I not want to be or want to be short in? I look into the fundamentals. I make the selection of my own processes. And then this, amongst a lot of other tools, gives me a very interesting point to say, if I want to enter into a trade, there's a high probability that something will happen or might happen at this point. So that's how I utilize it on a medium to longer term time frame, because these points, funny enough, always coincide with if you use volume profiles or all the other tools you have in there. You look at the open interest. If a lot of these points come together, you actually want to be ready and plan your trades. Our universe is huge, especially if you trade equities. You can trade 2,000 equities. I have the option volatility in the market. And when I reach these levels, then I put a trade in after I've done my analysis or my trade scenario through the proper original filters in the original narrative. And on a day trading level, even though I don't do day trading, it works fantastically because you're really in bloody random land. One of my students, he was using, 30-second candles or something. He did he programmed it for these 30-second time frames. And in this complete random market, it's awesome how the one standard deviations always give you time to look at something and close out positions or open positions. It's just, I'm bad at day trading, so I don't do it. I'd rather prefer the other bits.
Great.
Has that answered the question?
I think another question, actually, you may have answered it this one already, is what short and time frame for trades? My favorite time frames is about 1 month to 3 months, because that gives me the most liquid options I can work with. The voting blocks, as I've mentioned them over and over again, give reliable data for the sentiment the market is showing you. And you have liquidity in there. That's the most important point you can have. And as I'm coming a little bit from the random side of the market, Schiller and Pharma got both the Nobel Prize. Pharma said markets are random, and Schiller said they are not. And a third dude who checked them and said both are right got the Nobel Prize for this as well. I'm more from the random side out of my history as a market maker, because my clients were very clever guys. And they were trading directional markets. They had ideas. How could I have possibly survived while they are making a killing for 10, 20, 15 years? Because I would always have to sell the stuff which would run against me. So in the long term, it doesn't matter. It's all pretty much random. And that helps us in banks to actually have analysts and derivative desks at the same time. Great. Another question is around stop losses. So let's say S&P 500 is trading at, say, 4,000. So we're roughly around that level now. One strategy is to use options where you limit your downside. In your earlier slides, you had the chart of the histogram of the returns. So by using, if you buy a call, you basically cap, so worst case, so that your losses are limited. What happens if you take a cash position and you have a stop loss? So with a stop loss, you're capping your downside as well, and why not just do that rather than buying a call?
Well, I spoke a lot about theory today, and theory, when we're talking about options theory, markets are continuous, and the smallest tradable unit is 1 cent, and you can always trade as much as you like at this price. Obviously, that's all BS. It's not the reality. So the beginner, I would always recommend, if you use options, buy options. Yeah, there is a slightly negative profile to that, which is scope of another explainer we have in there, but you know at least what your downside risk is. If you just take cash positions according at these points, you should make damn well sure that you know when to get out. The question is, my profile for the last, I don't know, 100 years was I like to take 3 times the profits than I lose. But that is my personal style, also related to the 1 month to 3 month time horizon I have in there. And if that gives me the safety, even if I only have a 50-50 chance of picking the right stuff. By simply expected returns, I will not lose money if I'm sticking to my rules, which is another difficulty in this process of just working with stop losses. You might be traded at a level which has completely overshot your stop loss. Ask the guys at AMC, at Bed Bath & Beyond, or at Tesla. So
so options give you the certainty of the levels, whereas cash markets would not.
And I prefer to sleep well, Bilal.
There's another question here. Would you advise selling options outside the cones, or do you prefer to take directional plays when the security is currently at an extreme of a previous cone?
I do both. I love to sell options, obviously, because the probabilities are always on your side. You get a premium, the risk premium, and the market is pricing for that. The probability of making money is higher. Obviously, the payout you can get is predefined. There is no unlimited upside. But I have to admit, especially over the last couple of months, I was more on the long buying option side, because the market and the indicators we're using, especially the sentiment in the option markets, gave so many fantastic bloody trades out there where you could even play short term, 3-4 days into the future. When your levels came in and you saw the build up of all the indicators you are using, you suddenly had then 200-400% trades in terms of option premium multipliers in there. But the majority of my whole career, obviously, as a market maker, was always short options. People come to me because I produce them and they buy them. And once you've learned how to operate that and how to, get not bitten by the market, when to take your chips off the table, it's absolutely fine, and it gives you a steady income stream. And if my forecast for the next 10 years, right, maybe we won't see a crash. Maybe we'll see a market going sideways for 10 years, and then the option sellers are back, and you can generate huge amounts of income while keeping your risk under control. With a high volatility, that's perfect scenario. And
this is a kind of related questions. With options for 1 to 3 months, what sort of spreads do you utilize, or are they just call puts?
I work with a very easy stuff, actually, to the surprise of some of my students who ask me, "Oh, Thorsten, can you explain a Christmas tree and new stuff?" I read an article earlier. Somebody was talking, or there was a little video even, was talking about an iron shark. I never heard of that before, and I do this stuff almost 3 decades, but they always are very incentive. I use call spreads and put spreads. Very simple. An iron condor, if you put them together, when I sell options, because I can sell a call on the upside and I can sell a put on the downside, but I want to protect myself against the risk of going over these 3 standard deviations. And if you keep it simple like that, you sell, let's say the market is at 100, you sell a call at 110, and you buy a call with 105 against it, your risk is limited to 5. That's it. And you receive the premium. Again, and you have the probability you're within the 68% corridor if you do it at 1 standard deviations, plus your probability of profit is even higher because you receive that premium, which is also pushing a little bit further. Suddenly you're not at 1 standard deviation, you're a little bit further out again. Brings it higher.
Sides capped because you sold the call to the top side. So you get a bit of a kicker from selling the call, that premium. You side known as well then. Yeah. And then another question is, what's your view on longer dated options, such as 9 to 15 months?
Oh, as a market maker, I used to love them because the market is very illiquid. And if clients wanted to buy them and said you sold them a volatility of 20, and your next run to do the valuation of your book, you said, okay, the volatility has dropped dramatically to 19. And if longer dated options, they are more sensitive to volatility, you could book an insta profit. Till you had the next round in there. It's just.
But as an investor, would you do that or not? Or would you stay away from
longer dated
that?
options are actually very, very interesting if you have a long-term view on something. And then I use again calls and puts, something like a digital spread. I wanted to be bullish for one of the trades, which is not working out for me at the moment. At the beginning of the year, I had my usual midlife crisis, and I was surfing the Harley Davidson website and was really considering this time to buy a Harley. And I thought, no, the company's doing well. They have a German boss who's an engineer. The numbers were fantastic. Great. I see a breakout here. Volume is picking up. Everything lined up. And so I thought I'll buy a call, a longer dated call this time, with a level of 60. Stock was trading at 40. So I assumed I wanted to have a 50% move to the upside. And then I sold a call with a level of 61 against it. So why do you do that, Thorsten? I'm not interested in volatility anymore because they both trade at whatever the market says volatility levels are at this time, at 60 and 61. So I'm pretty much neutral there in terms of the long option and the short option I have. It costs less because I've already limited my profit to $1 in there, from 60 to 61. So if I can make with a very low probability $1, it probably cost me only 5 cents on the dollar. And then I can simply scale it and say, okay, I want to invest an X amount of dollars. If I'm right, I don't care whether the market is trading at 65, 70, or 90. I will get exactly this $1 minus the premium I originally paid, the 5 cents, and then how many times I did it. So that's the digital point where I then actually cut out the longer term volatility risk, where I can't really access what is the market pricing it properly, or is it some guy like me in his best years who says, well, I'm the long-term market maker for Harley Davidson, and the market is what I say it is, because what he cannot do, or she cannot do in this case, he can't make the volatility of the 61 I'm selling to the 60 I'm buying massively different.
Correct, yeah.
That is also how a market maker would make money. But if you take them very close together on a longer term, you at least are protected from that fallacy that could be out there.
Yeah. Now, we got a bunch more questions, but I think we might keep them for another webinar. One person has actually asked, can we have another webinar on options trade risk management, which I think makes sense. You know,
yeah, absolutely.
Kind of part two of this is we've set the groundwork in terms of volatility, cones. Next step would be how to use calls, puts, how do you risk manage your position. Yeah. So we will have a follow-up webinar on that. So you have a sort of building block.
Lovely. Happy to do that, because then it's getting really, really interesting. I demonstrated now that actually this helps us. Yeah, even if I couldn't care less to do any analysis in the market, I can still operate with a bell curve, which is obviously on the screens at all times, if I use the right tools in the right way.
Yeah. And just a final question, somebody was actually asking about your background. So what is the background that Thorsten, what's your background, Thorsten? It looks very impressive. So can you give us your version of your life, your background?
That's my villain's lair in the Swiss Alps I have in the background. It's just a generic background.
Yeah. Okay. Cool. Good. We can pretend that it's something more grand.
I sit actually in my library, but it's not as impressive as the one I have in the background.
Yeah. Okay. Cool. Good. And someone's asking about live coaching. But yeah, what we'll do is we'll hold a few more of these webinars, and then we're also constructing a coaching program as well. Just depending on demand. Locations, we're thinking about in-person conferences or webinars, Zoom calls with people and so on. So we just need to work out the logistics of it all. But send us feedback, people, in terms of what you want to know, and then we'll work out the right curriculum for this. So do kind of send emails to us or message any one of us, and we can follow up on all of those things. So with that, so thank you very much, Thorsten. That was really, really good.
That was my pleasure.
I
Always
really enjoyed
enjoyed working with you.
Yeah. And as I said earlier, there'll be replay. We'll send a link to the PDF of the presentation with a link to the tool as well. And then we'll have a follow-up webinar on some of the nuts and bolts of using calls and puts and so on as well. And hopefully this will be a series. Great. Okay. Thank you all for listening.
Thank you. Bye-bye. See you soon.
Bye.